Think about it for a second. If your money is just sitting quietly in a drawer somewhere, will it grow? Nope. But will it even stay the same? Absolutely not. And the reason behind that is inflation. Every year, things get more expensive. And if your money is just sitting there doing nothing, it's actually losing value. In simple words, saving without investing equals slow financial suicide. Your money quietly loses power every single year. Let's break it down with a real example. You save $1,000 today, you feel good that your money is safe, but 10 years later, that same $1,000 won't buy you what it does today. In fact, it might only be worth the equivalent of $700 in today's value. So unless your money's growing, you're falling behind financially. And that's why investing isn't just an option anymore. It's a necessity. But hold on, the big question is, where do you invest and when should you start? Short answer, the earlier the better. Long answer, that's what this whole video is about, because I'm going to walk you through exactly how beginners can invest safely, smartly, and with confidence. Just a quick note, this video is not financial advice. It's for educational and informational purposes only. So let's start with the basics. And the very first step is 1. Build a strong financial foundation. Before you even think about investing, your financial base needs to be solid. Do you have any high interest debt? Do you have an emergency fund? Do you have a stable income source? And most importantly, do you actually understand what you're investing in? If the answer to any of those is no, then focus on those things first. Let's break each of these down. Step 1. Get rid of high interest debt. If you're carrying credit card or personal loan debt with 15 to 20% interest, investing can wait. What's the point of trying to earn an 8% return if you're losing 20% on debt? It's like you bought a car but the brakes don't work, dangerous and pointless. So pay off that high interest debt first. That's your guaranteed risk-free return. Step 2. Build an emergency fund. Life is unpredictable. Job loss, car breakdowns, surprise medical bills, anything can happen. That's why you need an emergency fund. At least 6 to 12 months worth of expenses. Keep it in a liquid savings account, somewhere safe and accessible without penalties. Bonus points if that savings account earns inflation-beating interest. Step 3. Have a consistent income source. Investing isn't a shortcut to wealth. It requires consistency, discipline, and long-term thinking. So first, build a reliable income stream, whether it's from a job, freelancing, or a business. Investing only works when you can regularly contribute, regardless of what the market's doing. Step 4. Invest in financial education. These days, everything is available online. YouTube, podcasts, blogs. Financial literacy is no longer optional. If you're watching this video right now, you're already 10 steps ahead of those who are binging Netflix instead. So never compromise on your learning. Now let's get to the core. Investment options for beginners. The smart way to begin is to go from low risk to high returns, step by step. Option 1. High yield savings accounts. This isn't technically investing, but it's perfect for short-term savings and emergency funds. Look for online savings accounts offering 4 to 5% annual interest. Most traditional banks are still giving only 0.01%, which is basically nothing. With high yield accounts, your money stays safe, FDIC insured, and it's easy to access. But remember, this is for safety, not growth. Option 2. Bonds. A low-risk investment option, especially if you want predictable income. When you buy a bond, you're lending money to a government or a company, and they pay you interest plus your full amount back after a fixed period. Bonds are stable but not super flexible. If interest rates change, the market value of your bond can go up or down. If you're looking for safety, government bonds are a good place to start. Option 3. Index funds and ETFs. If you're thinking truly long-term, 10, 20, 30 years, this is the place to be. Index funds like the S&P 500 give you exposure to the 500 biggest US companies. Apple, Amazon, Microsoft, and more. These funds are low cost, diversified, and easy to manage. Use dollar cost averaging. Invest the same amount every month, no matter what the market is doing. Historically, the S&P 500 has returned 7 to 10% annually after adjusting for inflation. This is how you win the long-term game. Option 4. Individual stocks. This is the most exciting and most risky investment route. You're betting on the growth of a single company. If the company does well, your stock goes up. If it fails, you lose money. For beginners, it's best to keep only a small portion of your portfolio in individual stocks, mainly for learning. Until you understand balance sheets, earnings, debt, and growth forecasts, don't go all in. So, where should you begin? Start simple. Build an emergency fund, pick an index fund or ETF. Set up a monthly auto invest, and most importantly, stay patient. Markets will rise and fall. But if you're in it for the long haul, short-term noise won't matter. Investing is a habit, and the sooner you build it, the sooner you'll reach financial freedom. And hey, If you've watched this far, you're clearly serious. And if you keep up this energy and consistency in your investing journey, you won't just have money in the future, you'll have freedom and options. So hit the like button, subscribe for more, see you in the next one. Bye.